Today is January 3rd, and this is the ADM Investor Services Weekly Market Kickoff video. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services, Archer Financial Services, or Archer Daniels Midland Company. Today's guests are Alan Bush, the Senior Financial Economist at ADMIS, and Mark Soderberg of the Ag Hedge Team at AFS. Happy New Year, guys.
Happy New Year.
Mark, let's start with the grain markets this morning. As 2016 came to a close, spot corn prices were down just over 5 cents a bushel from where they began in 2016. Winter wheat prices were down nearly 70 cents, while soybeans were up $1.40. As we go through 2017, do you expect soybean prices will continue to be the upside leader while the other grains lag behind?
No, not necessarily. For me, it's real hard to get overly bearish corn and wheat prices from these levels. We began the year, during the year, we traded spot corn prices down to the $3 level, levels that have not been seen in over 7 years. Chicago wheat prices traded under $4 really for much of the fourth quarter of 2016. These are also levels not seen for over 10 years. When you look at the fundamental picture for both of these markets, it's really hard, really easy actually, to come up with such a negative story. Global and U.S. wheat and corn supplies are either at record levels or highest levels we haven't seen in decades. Beans, on the other hand, really a similar fundamental picture following this year's record harvest of beans in the United States. U.S. stocks are expected to swell to the highest levels in 10 years, while global inventories are actually at record levels. If you recall, we began 2016, soybean prices were quite cheap, at under $9 a bushel, and this is the first time in 7 years they've been this low. We had a big spike in the spring months, and then prices seemed to level off as we got through 2016, when it became rather apparent we're going to have a big U.S. crop. We ended the year very close to the $10 level, kind of consolidated right around there. The biggest difference that I see in corn and wheat versus soybeans is the role of the speculative trader. In soybeans, the large speculative traders were pretty much long the entire year in 2016. They ended the year long just over 107,000 contracts, which is not a record large position, but a rather healthy position. I think it makes that market vulnerable to some speculative type selling. Corn and wheat, on the other hand, they were short almost the entire year in 2016. And they ended the year with rather healthy short positions. So I think there you're going to see a little bit of fun short covering as we get into the first quarter of this year, and should lead to higher prices. I guess I'm also a firm believer in the Econ 101, and that the best cure for low prices is just that, low prices. In corn right now, the USDA has a record demand forecast at 14.6 billion bushels, which is not only a record, but it's a record by almost 1 billion bushels over the previous record. And I think that's still too low, as we see very strong exports and the demand for the production of ethanol, both running above the pace needed to hit the current USDA forecast. So I would look for both corn and wheat to outperform soybeans here in 2017.
So given your outlook and the current prices in the marketplace, how do you see the acreage mix in the U.S. for 2017? Will farmers be switching from corn and wheat to beans?
Yes, I think so. Next Wednesday, we get a report from the USDA. Will they not only give us the final production numbers for 2016 corn and soybeans, but we also get our first estimate on the 2017 wheat acres. Now, this is a crop that was planted this past fall by farmers. Given the low prices in wheat, we expect acres to be down about another 3 million from what was planted last year. This would drop winter wheat acres down to 33 million acres, which is the lowest winter wheat acres here in the United States in over 30 years. And it just continues the long-term trend of fewer and fewer wheat acres. When you look at corn and soybeans, on the other hand, we're looking at new crop prices and how it relates back to the U.S. farmer. Right now, the marketplace is screaming for more soybean acres from U.S. producers, and I think that's exactly what we're going to see. We expect corn acres to be down about another 4 to 5 million from what was planted last year, dropping acres to right around 90 million. Soybeans, on the other hand, we're probably going to see about a 4.5 million acre increase up to a new record at 87.5 million acres.
Mark, I know you and your team, the Ag Hedge team, you work with both end users and a good number of farmers as well.
Correct.
What is your hedge team advising your farmer customers to do in the marketing of their 2017 crops?
It's a difficult environment right now. Many of the producers that we talk to indicate to us that new crop corn prices are below, and in some cases, well below their costs of production. Soybeans, on the other hand, at over $10 a bushel. November soybeans have been flirting with this level now for a couple of weeks. Actually, now they've drifted down below that. Farmers can make money. They can cover their costs and still generate a little bit of a return to their farm operations. And I think more than anything, that's what we stress to our clients is to know your business operation inside and out. Know what it costs you to produce these bushels. From there, that's a good starting point to develop targets. Know what your break-evens are. Develop some targets above the market to lock in some rate of return. And you know, that's, I think, the golden rule for any business to be successful over the long term. You know, and that's the best way I know to stay in business is to simply sell your product or service for more than it costs you to produce it.
So you got to be ready and you got to be disciplined.
Yeah, we're telling our farmers over $10 on beans. Be prepared to lock in 35 to 40% of your production ahead of planting. How you do this really boils down to each individual's tolerance for risk. And corn, we're emphasizing be a little more patient. We think, yeah, historically, odds favor that you'll get better opportunities down the road. We're looking at the 425.
Generally, we'll see a spike or two in the calendar year, and you got to be ready to jump on those.
Precise, exactly. Something will trigger that. We just don't know when and where.
Alan, let's turn to the financials for a minute. In November of 2015, it appears as though the trend toward global deflation was halted as signs of global inflation emerged. In 2016, inflation levels around the world increased only modestly. What is your outlook for inflation in 2017?
Okay, well, this year we anticipate that inflation is going to accelerate, and it's not just going to be commodity inflation, it's going to be wage inflation as well. In fact, we did see a report today that showed that German inflation numbers came in on an annualized basis at 1.7%, and that was substantially above the guess of 1.3%. So we're already starting to see some of these numbers indicate that inflation is coming back. Also, we had some PMI numbers this morning showing a big increase in the prices paid portion. So inflation already becoming an issue and is likely to become more so as the year wears on.
I guess the right follow-up to that question is, if inflation is coming back and potentially accelerating, how will this affect the interest rate futures market?
Well, of course, it has to be bearish. If commodity inflation is coming back and wage inflation is just starting, these are both very powerful inflation numbers. So we have to remain bearish on the interest rate futures markets, especially the 30-year bonds, which are most susceptible to higher inflation levels. So this is a trend that we have seen for much of last year, lower on the interest rate markets, and it will continue well into 2017 to the downside. So trade these markets from the short side.
Let's talk a little bit about the Fed. If the FOMC is on track to hike interest rates 2 to 3 more times, or 2 to 3 times in 2017, and higher interest rates are normally considered to be bearish for stock index futures, how can the stocks continue to advance in the face of tighter credit policy in 2017?
Well, the short answer is that rates, even when they are increased 1, 2, or 3 times this year, they will not be high enough to reverse this bull market. There's a certain high level that comes into play that actually is a tipping point. 1, 2, or 3 rate increases is just not enough to reverse this bull market.
Historically, we're still at pretty low interest rates, and we will be
Yes.
for some time.
Exactly.
What are the key January indicators we should be watching for in regard to the stock futures here in January?
Okay, the January indicators, basically there are 3. Whatever the market does in the first day in January, the first trading day, often reflects what is going to happen for the rest of the year. And of course, we're off to a very good start already today with stock indices substantially higher. The second one is the first week in January. Wherever that week goes often is another indicator for the rest of the year, and then the first month. So far, we're seeing the first day very much an up day, and I would anticipate that we may see the 1 week indicator friendly, and I'm anticipating this the full month. Now, these are very important indicators. They've been rather reliable in the past. With or without all of the other indicators, we will remain bullish the stock index futures through this year with what we're seeing currently in the fundamentals and also in the technicals.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services, Archer Financial Services, or Archer Daniels Midland Company. If you'd like more information about our brokerage services or would like to open a trading account, please visit www.admis.com.